Okay, so this video is on accounting for joint arrangements. So there are two types of joint arrangements, joint ventures and joint operations. So at a very basic level, joint ventures, the owners are entitled to a share of the profits, and the actual joint venture itself is normally structured through a different legal entity. So the two different companies will come together, they'll create a new entity to run the joint venture within. And in terms of accounting for a joint venture, we use the equity method of accounting, which is the same as the associates topic, the exact same way we'd account for an associate. And so because of that, this video is really just going to focus on joint operations. So for a joint operation, the owners share in the output. It's not structured through a separate legal entity, so it just means the two entities come together, put their resources together, and operate together. And they recognize the operations in their own financial records. So that's what we're really going to go through in this video. So joint operations accounting, really the two joint operators just want to record their fair share of assets, liabilities, output, revenue, expenses in their own financial statements. So this is a general framework and the steps for our joint operation accounting. So we need to record our initial contributions to the joint operation. So these can be cash or non-cash. We need to recognize our share of assets and liabilities at the end of the year. And so we take 50% for each entity because it's a joint operation, so they own 50% each. So we just take that information from the joint operation financial statements. Now we need to record or adjust our depreciation. So depreciation can either be recorded separately in the individual entity accounts of each joint operator or in the accounts of the joint operation itself. Now, when we do the second one, we need to do an adjustment we need to do an adjustment for the party which actually contributes the asset, and so we'll go through that a little bit later. And then we also need to account for our management fee. So sometimes one of the joint operators is paid a management fee for actually managing the joint operation. So I've got an example. So Deggers Limited and Rareco start a joint operation 1 July 2017. So their contributions, Deggers Limited contributes $10 million cash and $10 million machinery at fair value, which has a carrying amount of $8 million, and Rareco contributes $20 million of cash. Additional information, machinery is depreciated at 10% per annum in the joint operation accounts, but I'll also do it as if they did it in their individual entities just to show the difference. 70% of the distributed inventory was sold for $800,000 by the end of the year, and during the period, the joint operation pays a $500,000 management fee to Deggers Limited, and it costs Deggers $300,000 to provide these services. So we're going to prepare the entries for the joint operation at the end of the period, so 30 June 2018, effectively. So this is just some financial information that will come back to at the end of the question. So we've got our balance sheet and cost incurred statement. So step one, contribution of assets. So firstly, we'll deal with how Deggers would record this contribution. So first entry for Deggers, debit cash in the joint operation. So if we look at the actual assets that were contributed, we know that Deggers put $10 million cash in, Rareco put $20 million cash in. So this is a total of $30 million cash, which has gone into the joint operation. Now we know that each entity should share equally because they both own 50%. So when we take half the 30 million, then Deggers will be entitled to $15 million of the cash in the joint operation. So they recognize that through this debit, cash in joint operation for 15 million. The next one, Deggers will debit machinery in the joint operation by $4 million. So now the reason it's $4 million is because Deggers, right, was the party that originally contributed the machinery. So they want to always recognize this machinery at original cost. So they're going to use the carrying amount of $8 million for their recognition when they put it into the joint operation. Okay. Now we know because they've contributed to the joint operation, they're now only entitled to half of that machinery. So if the carrying amount was $8 million when they put the full machinery in, 50% of that $8 million is $4 million. So from Deggers Limited perspective, that machinery is worth $4 million, but it is now sitting in the joint operation. So we need to debit the machinery in joint operation by $4 million. Next, we'll credit the machinery by $8 million. Why? Well, it's just because Deggers originally had the $8 million machinery. They've now put it into the joint operation, so we're clearing it from our balance sheet, and we re-recognize the 50% of the machinery that Deggers was entitled to, but we just move it into the joint operation machinery account. Okay, so we've cleared the entire original carrying amount, and we've just recognized half that is now in the joint operation. Our next one is credit cash, $10 million. Again, because Deggers Limited gave $10 million cash to the joint operation, we are just crediting that entire amount out. And then obviously we recognize the cash they were entitled to in our first entry. So this is just the amount that they actually contributed. We're crediting that entire amount out. And we credit our gain on sale of $1 million. So the reason we do this is because the joint operation always recognizes assets at their fair value. So we know that Deggers Limited has effectively sold half of that machinery to Rareco. So from Deggers Limited perspective, 50% of that machinery is worth $4 million. But from the joint operations perspective, the entire amount of that machinery is worth $10 million. So the half that is sold to Rareco is worth $5 million. So Deggers has sold machinery that from their perspective is worth $4 million to Rareco for $5 million. And so they've made a $1 million gain on sale. So they're all the entries for Deggers. So now we'll move on to Rareco. So Rareco will debit cash in joint operation, same reason as Deggers. There was a total $30 million cash contributed. When we divide it by 2 to get Rareco's individual share, we get $15 million of cash in the joint operation that they're entitled to. They will debit machinery in the joint operation of $5 million. Why? Because Deggers contributed $10 million worth of machinery at the fair value. Okay, because Rareco is effectively acquiring half of that machinery when it's contributed, they will recognize their original cost at fair value because that's their acquisition cost of it. And so that's why they debit the machinery by $5 million because they now own machinery which costs them $5 million to acquire within the joint operation. Now the next entry is credit cash of $20 million. Why? Simply because they contributed $20 million cash to the joint operation, so they credited it out of their financial statements because that is the amount they contributed. And again, on the first line, they recognized the total amount of cash that they're actually entitled to that has gone into the joint operation. So that are all the entries for Rareco. So the key thing is just when you have non-cash assets, you need to make sure for the actual contributor of that asset, you recognize using the carrying amount. But for the non-contributor of that asset, use the fair value. So Deggers was the contributor of the asset, Rareco was the non-contributor. So next, we need to do our journals to recognize our share of assets and liabilities. So there are a few journal entries for this step, but it's not too complicated. So I'm going to do the recognition for Deggers and Rareco if there was depreciation in the joint operation and as if there was depreciation outside of the joint operation for our share of assets and liabilities. So the entries I do here are identical for each entity. So they only represent one entity's entries, but they will be the same for the other entity. Okay, so what we're going to do, these effectively are our entries. So all they are is I've looked at our balance sheet. I've got the total amount on the balance sheet. I've divided it by 2. And then I have recognized it in our own records based on if it's an asset or liability. Why? Because our balance sheet shows the entire assets and liabilities of the joint operation. So if we divide the number on that balance sheet by 2, that gives us our 50% share for the individual entities. Okay, so for example, I've recorded cash of $2.95 million here. Well, if we look at our balance sheet, we can see cash was $5.9 million. When you divide that $5.9 million by 2, you get $2.95 million. Now I've debited cash because cash is an asset, and so we're recognizing the fact that we're entitled to $2.95 million in the joint operation on our own financial records. So, same with raw materials, WIP, and inventory. If I divide all of these numbers by 2, okay, so for example, WIP would be 300,000 when divided by 2, inventory 100,000, raw materials, you can put it in your own calculator if you want. We get these numbers. So I said WIP was the 300,000, inventory was 100,000, we divide it by 2. Raw materials, 12.875 million is half of that amount on the balance sheet. Okay, so they're all nice and simple recognitions. All you have to do is look at the balance sheet, divide the number by 2, and then recognize whatever item it is in joint operation, debit it by the appropriate amount. So we'll have a look at inventory now. So we've recognized our inventory, which is currently sitting in the joint operation. So that's the $100,000, okay, which was this figure divided by 2. But you can see here, I've also recognized $700,000 worth of inventory asset, which is not in the joint operation. So the way I came up with this figure, if I look at my cost incurred statement, I can see that the cost of inventory was $1.6 million during the year. So that means that $1.6 million worth of inventory was produced. If I then look at my balance sheet, I can see that $200,000 inventory remains within the joint operation. So when I take this $200,000 away from the 1.6 million, we get $1.4 million worth of inventory, which must have been distributed out to the individual entities. So basically, to recap, the joint operation produced $1.6 million worth of inventory. They only have $200,000 on their balance sheet at the end of the year. So this means the difference, which was 1.4 million, was distributed out to the joint operators. So they've been taken out of the joint operation and given to the individual entities. So, because we know 1.4 million was given to the individual entities, that means they would have taken a 50% share of this individually. So they would have taken $700,000 worth of inventory each. So if we go back and look at my journal entry, you can see I've debited inventory by $700,000 to recognize the fact that the joint operation has given the individual entity $700,000 of inventory. Okay, it's no longer in the joint operation because it's been distributed out. So our next one, machinery. Now, there is a balance of machinery on our actual balance sheet, but you can see that I haven't actually recognized any amount. Now, the reason for this is because, if you remember, to start off with, $10 million of machinery was actually contributed to the joint operation to establish it. And so we have already recognized this $10 million of machinery in our original contribution journal entries. So we don't need to re-recognize it again, right? So $10 million was contributed. There's $10 million in our balance sheet, so we know that we have already recognized that amount. Now, let's say, for example, that machinery sitting on our balance sheet at $11 million. Well, that means we'd have the $10 million of machinery that we contributed at the start, plus $1 million which was purchased during the year. If that was the case, we would need to take this $1 million, divide that amount of machinery between the two entities, and we would recognize the $500,000 for each individual entity of machinery that had been purchased. But as we know, because it's $10 million here, that's how much that has been contributed. We've already recognized it, and so we don't need to recognize any more. So now if we move on to our liabilities, I've gone through the exact same steps. So if we look at our accounts payable, accrued expenses, and our loan in joint operations. So if I go back to our balance sheet, we can see accounts payable was $600,000. So half of that is $300,000. Our accrued expenses, half of the 250 is 125,000, and our loan, half of the 2 million is 1 million. So you can see back in my entries, I've just taken the amounts here. I have divided them by 2, and I have just credited the items, okay, because they're liabilities, so we need to credit them when we're recognizing them. Okay, and because we know that these liabilities exist within the joint operation, that's why we need to recognize them as accounts payable in joint operation, for example. Now, again, somewhat a special item here, we've got a credit of cash in joint operation for $15 million. Now, if you remember, when we were recognizing our initial contributions, we recognized a debit of cash to $15 million. So all I'm doing here is I am crediting cash out in the joint operation by the exact same amount as I recognized in the original contribution that I was entitled to. Now, the reason I'm doing this is simply to make it nice and easy. You can see I've got the credit of cash in joint operations down here of $15 million and a debit of cash in joint operations here of $2.95 million. Now, if you take $15 million and you take 2.95 million away from that, that amount is $12.05 million. So effectively, the debit and the credit will offset to have a $12.05 million reduction in our share of cash in the joint operation. Now, if we go back to our balance sheet, we know that originally $30 million of cash was contributed to the joint operation. We can see at the end of the year, our balance sheet, we only have $5.9 million cash left. So if I take $5.9 million away from $30 million, then we know that we've spent $24.1 million during the period. Now, if I divide that $24.1 million by 2, that comes to the $12.05 million amount that we need to recognize as a reduction in cash. Okay? So you can see when we offset the debit and credit, that comes to that $12.05 million reduction in cash that we need to share in. But to keep it nice and simple, what I would recommend, you don't have to, is you debit cash by 50% of the amount which is on the balance sheet. Okay, so our 5.9 million divided by 2. And you credit cash by the amount that the individual entity was originally entitled to. So in our contribution entry, we had debit cash of 15 million. So that means here I'll credit cash of $15 million. That just keeps it nice and simple and hopefully reduces the chance of mistake. Now the other one here is credit our accumulated depreciation, our joint operation, by $0.5 million. So again, we look at our balance sheet, we can see there was a $1 million of accumulated depreciation. We divide that by 2. Each entity should be recognizing $500,000 worth of that. So that is the reason for that. So that is when depreciation is recorded inside the joint operation. If we go look at our entries where depreciation is outside the joint operation, the process is exactly the same. The only difference is that we don't have a credit to accumulated depreciation down here. Okay. And so that means that some of our accounts up here will have a slightly reduced balance as well, but that would simply be reflected on the balance sheet. So there's no extra trick you need to know there. Simply, you would just take half of the amount of the numbers on the balance sheet for all of these other entries. Okay, so there isn't really a major difference, just that there'll be no credit accumulated depreciation, and so the numbers on the balance sheet will be slightly different to make sure that our entry still balances. Okay, so the numbers that I have reduced are all inventory related accounts, and we will see later an example why I chose those accounts to reduce. So we're up to step 3 now. We're going to look at recording our depreciation expense or our actual adjustment for our depreciation expense. So we'll start with if the depreciation expense is recorded outside of the joint operation by the individual entities themselves. So in this case, right, we're doing these entries here. Well, we're not doing those entries, but we're doing it for this same situation. And so this would mean that there'll be no accumulated depreciation on the balance sheet. So we're doing it in the situation where the individual entities record depreciation expense in their own accounting records. So we'll start with Deggers. They have recorded a depreciation expense of $400,000 a year. So we know that originally Deggers contributed the asset of machinery to our joint operation. So from Deggers' perspective, that machinery had a carrying amount of $8 million. Because they sold off half, they now only recognise that they own $4 million worth of machinery. Now, our question tells us that we wanted to depreciate machinery at 10% per annum. So if we take Deggers' $4 million amount of machinery that they recognise and we multiply that 10%, we get a $400,000 depreciation expense per year. So we just record that amount with our normal depreciation expense entry. So we debit depreciation expense and credit accumulated depreciation. Now, Rareco. Same journal entries, different numbers. The reason for this is because when Deggers contributed that amount of machinery to the joint operation, it had a fair value of $10 million. And so from Rareco's perspective, they have acquired this machinery when it had a fair value of $10 million. But because they're only entitled to half of that, they recognized their share of the machinery being at $5 million. Now, when they multiply that $5 million amount by 10% per annum, they would get a $500,000 depreciation expense per year. So that is why they're recognizing the $500,000 of expense every single year. So we know the entity which contributes the asset will use the carrying amount when they contribute it, but the entity who received part of that asset will use the fair value when it was contributed. Okay, so that's that. Now we're going to do the adjustment as if depreciation was recorded in the accounts of the joint operation. So from this point of view, there would be no adjustment from Rareco's perspective because the joint operation uses the fair value of the equipment. The joint operation itself always uses the fair value of any assets contributed. And so Rareco wants to recognize their asset at fair value, and so they don't need to make an adjustment. But from Rareco's perspective, sorry, not from Rareco, from Deggers Limited's perspective, they contributed the asset and they want to use the carrying amount for their depreciation expense. So we need to be making an adjustment. So if we look at our cost incurred statement, we can see that depreciation expense has actually been capitalized into the value of inventory. That means that the cost of inventory and the work in process and any inventory that was distributed outside of the joint operation, the actual value of it that is recognized on the balance sheet includes the depreciation expense because we have capitalized it into the value of that inventory. So we know that the joint operation is depreciating the asset using the fair value, which means that they're depreciating it at $500,000 per year. But we know Deggers Limited wants to depreciate this machinery at $400,000 per year. So this means that across the work in process, the inventory account in the joint operation and the inventory which has been distributed out, they are overvalued by $100,000 from the perspective of Deggers Limited. So we need to make adjustments to reduce the value of these three accounts by $100,000 in total. So the way we actually calculate how much we need to reduce these accounts by, I've put into this table down here. Now, when I add up Deggers Limited's share of WIP in the joint operation, its inventory in the joint operation, and its inventory distributed outside, this comes to a total of $1.1 million worth of inventory. So, where did we get these numbers from? We can either look back at our entries we've done here. We can see we took a share of 300,000, a share of 100,000, and a share of 700,000. So we know that they are the correct numbers of those three inventory accounts that we are actually sharing in. And so the way that we're calculating how we are going to share this depreciation reduction across these three accounts is like this. So we are just looking for the proportion of each individual account of the total amount. So all we've done is I've done $300,000 divided by $1.1 million. And so I know that 27% of these three, of the value of these three accounts is in my WIP account. Same here. I know that 9% of the total value sits in my inventory and joint operations account. I know that 64% of the total value of these three accounts sits in the inventory account, which has been distributed outside. So I want to reduce the value of these three accounts based on their proportion of the total, because this $100,000 of overstatement is included in this total. Okay, so from our perspective, the total should actually be $100,000, $1 million. But we want to then share the reduction equally across these three accounts. Well, not equally, but based on their proportion of the total. So when I multiply the $300,000 by 27%, we get this amount. Same by inventory, we get that amount. Inventory by itself, that was inventory and joint operation. Right, so the 700,000 by 64%, we get this amount. Okay. So obviously, these percentages or decimals have been rounded slightly, but these actual multiplication amounts reflect the proper percentage amounts. So how are we going to record this adjustment? So we'll debit our accumulated depreciation because we believe we've depreciated by $100,000 too much. And we're going to credit all of these accounts by their proportionate share of the total. Right? Because we know that depreciation has been capitalized into inventory, we know that our three inventory accounts combined together are overvalued by $100,000. So we need to reduce their combined values by that $100,000. And we know that because our current total value is 1.1 million, we want to get it down to 1 million. And so this overvaluation will have gone into each individual account based on their proportionate value of the total. So we've just gone, okay, we're entitled to $300,000 WIP in the joint operation. Of that total 1.1 million is 27%. Okay, and so that means 27% of that 100,000 has been put into the WIP account. So we need to reduce it by that $27,000. So that's how we're getting those entries there. Okay, so hopefully that was okay. Our next one, we're doing step 4, management fee. So RareCo, no adjustment needed. Why? Because Deggers Limited is providing the management fee or providing the management services. So RareCo shares in half of the management fee, which from their perspective is absolutely fine. Okay, they've been provided a management service. They're happy to pay for that management service. But from Deggers' perspective, right, they have received money for providing this management service, but from their perspective, they haven't actually provided the full value of the service. So we know the management fee was $500,000 for the joint operation, but from their perspective, they only provided $250,000 of that service. Why? Because half of the service they were providing the RareCo, but the other half they were providing to themselves. So that's not really an actual service, right? That is just, they're not providing, they shouldn't be deriving any revenue off that. They're simply just undertaking normal management operations for themselves. So the way we'll be recording this, right? We know that the management fee was $500,000. So originally, Deggers Limited would debit cash by $500,000 because the joint operation would pay them that much for the management, and they would credit fee revenue by $500,000. Makes sense. Now we know that the cost of supplying this management services was $300,000. So Deggers would debit cost of services by $300,000 and credit cash $300,000. Why? They're recognizing the expense for providing the service, and they would have had to pay cash to actually meet the obligations for those costs. So again, that makes perfect sense. But as I have explained, we know that Deggers only believes that they're actually providing $250,000 worth of this service because that is the amount that they're providing to RareCo. The other $250,000 amount, well, it's not really fee revenue because they're just providing a management service to themselves. So it's, they shouldn't be recognizing revenue for providing something to yourself. It's like if you take $5 out of the ATM, you don't magically have $5 more. You've just given it to yourself in a different form. So what are we going to do? Well, we're going to debit fee revenue by $150,000 and credit cost of services by $150,000. So the way we get the amounts for this first entry here is we look at what the cost of the service was, which was $300,000. And we know that half of that cost relates to providing services to RareCo, so we're happy to recognize that. But the other half we don't want to recognize because we're just providing it to ourselves. So we debit fee revenue of $150,000 because we want to de-recognize the revenue related to half of our cost. And we're crediting cost of services because we only want to recognize, well, we want to reduce the actual cost recognized by $150,000 because we only want to recognize $150,000 of cost. Okay, yes, there was $300,000 of cost associated with the service, but right, $150,000 of that went to Rareco, $150,000 of that was spent on providing services for ourselves, so we don't want to recognize that. Now, we know that, right, we need to reduce our fee revenue by $250,000 in total because we only want to recognize half of that. Now, we've reduced it by $150,000 here, so that's not quite half yet. We need to reduce it by another $100,000. Now, the way we do that is we debit our stuffed up there. We've debit our fee revenue by $100,000 to reduce our total fee revenue by 250,000 because we've got the debit here of 150 plus the debit here of 100 means the total reduction in fee revenue is now $250,000. And we're crediting our WIP, inventory and JO and inventory accounts again. Now, the reason is the same as what we did in the previous depreciation expense adjustment. Because in our cost incurred statement, the management fee is capitalized in the cost of inventory. So we need to actually reduce the value of our inventory by $100,000. So the reason it's $100,000 is because we know that we received $500,000 for providing the services, but it cost us $300,000. So the profit is $200,000. But we only want to recognize half of that profit because half of the services were actually provided to ourselves. So the total profit we want to recognize is $100,000. So we are debiting our fee revenue by $100,000 here, but then we're crediting out our WIP in JO, our inventory in JO, and inventory accounts because we know that our actual inventory is overvalued, or our three related inventory accounts is overvalued by that $100,000. This is the exact same process as we went through before in the depreciation adjustment. So we know that our total was 1.1 million. When we take the proportionate amounts of each account of this total, we get the percentage. We then multiply that percentage by the fee revenue reduction, and then that gives us the amount that we need to reduce each individual inventory related account by, because we know our inventory is overvalued by that $100,000, right? Because of that $100,000 profit that we don't want to recognize, or that revenue. And so we reduce our inventory related accounts because that management expense was capitalized into inventory. So it was just a complete coincidence that the fee revenue reduction and depreciation adjustment both happen to be $100,000. So our credit amounts are exactly the same. So that's dealt with there. Now, one tiny final thing, right? We know that in our additional information, it says 70% of distributed inventory was sold for $800,000 by end of the year. So that distributed inventory was that $1.4 million worth of inventory that we calculated earlier. So we want to recognize our sales of this inventory. So from Rareco's perspective, this inventory costs $700,000. When we multiply it by 0.7, then we know that our COGS will come to $490,000. And so we should also reduce our inventory by $490,000. Then we debit cash $800,000 because that's how much we sold it for, and we credit revenue by $800,000. So that's pretty straightforward from Rareco's perspective. But from Dega's perspective, we've just made all of those adjustments, right, to the value of our inventory. So the debit cash credit revenue entry is exactly the same, but our COGS calculation is slightly different. So we know we sold 70% of our distributed inventory. So that's this one down here, this inventory account here. So we know we've reduced the value of our inventory by $63,636,000. for our management fee adjustment and by 63.636 for our depreciation expense. Right, so we've reduced the value of inventory. So when calculating our COGS, we need to take the $700,000 original amount. We take away these two adjustments that we made because we credited the inventory, reduced its value, and then we multiply it by the 0.7 to get our cost of goods sold. So that comes out to 400.909 thousand and 400.909 thousand. Obviously, again, okay, so that is all we do. We know that it originally cost $700,000, but from our perspective, because those two, the depreciation expense and management fee, were capitalized, we needed to reduce the value of inventory because from our perspective, there was too much of those expenses. And so, because we reduced the value of our inventory, we need to use a reduced cost base to calculate our COGS. And so that's why we've done this calculation here. Look, so that's the end of this video, and I hope it was useful.